Hi everyone, Steve Nielsen here. It's been a little while since I've come to you with a video, but I thought it was timely just to drop in and have a chat about what has been happening in the Ukraine and just give you our take on the situation. As always, with our presentations, the information that I'm going to give you this afternoon is general in nature, not targeted to your personal circumstances or situation, and as such, you should only rely on it just as general information. If you'd like to see how things apply to your own personal circumstances, please don't hesitate to reach out to us and we'll make an appointment and offer to provide you personal advice. So this afternoon, I thought I'd just cover a little bit about the background between the Ukraine-Russian situation, what has led us to where we are today, certainly give you a history of geopolitical market sell-offs and their recoveries thereafter, and maybe put this in context a little bit. And then I talk a little bit about what we think you should do next and why we think you should do that. So essentially, conflict between Russia and the Ukraine is certainly nothing new. So in 2014, when the US, then Russia, annexed Crimea, there was conflict and fighting within the Ukraine. Certainly, being Russia shooting down the jet has caused strong condemnation around the world, and the Tony Abbott shirt fronting offer that he made at that time, certainly not really a market darling, the Russians, and this situation is certainly not seen as one where they have endeared themselves to the rest of the world. In fact, many people in Russia are protesting, and hopefully this upward pressure coming from their own people, as well as world pressure through the sanctions that I'll talk about, may be enough to effect some change. Ukraine itself is not an economically strong country, and it has declined even further since the breakup of the Soviet Union in 1990. What Russia are trying to do here is gain change. They want to gain change of the government and bring the country back in line with the Russian sphere of influence. It's foreshadowed that the invasion itself won't last long, that Ukraine will bend and break pretty easily. It doesn't appear that that is actually what is happening over there. The Ukrainian people are resolute in their support and their defense of their country, and certainly this has been probably a bit of a stone in Putin's eye at this point. What's at stake is fairly significant. Russia, as we all are aware, is a big contributor to energy and oil, and in fact contributes about 10% of global production of oil. Europe is particularly reliant on the gas, which is one of their energy exports, and there in fact was a pipeline that was currently underway that was going across Germany that is now being put on hold as a result of the incidents that have happened in the Ukraine, which will basically have some big impacts in Europe. Russia is obviously very dominant in commodity markets as well, particularly wheat and the materials required to produce fertilizers. So 65% of the world's fertilizer materials comes from Russia, and 25% of world production of wheat. So certainly not a small player. Likely impacts of the incursion into the Ukraine and what's likely to come afterwards. Oil and commodity prices will and already have started to increase. We're seeing oil test $100 a barrel at the moment. Gold will be a short-term flight to quality beneficiary, as what happens when we see impacts which cause commodity prices to increase, but also a safe haven for share market investors that may be a little bit concerned about the volatility. There's a significant disruption that the action in the Ukraine will have on the world. The sanctions that the world has introduced will hit certain industries. Now, there'll be two ways. Now, the point of sanctions is to cause significant economic disruption into Russia, so that the people of Russia will rise up and put pressure on Putin to get out of Ukraine. That's the primary measure. Unfortunately, there's a byproduct in that the costs of energy, as I mentioned, the gas supply into Europe is going up. There's gas rationing that will occur, and we've already seen increases in prices hit the world markets for oil, as I've said. Impacts on computer chips, on banking as well. The issue with Russia being cut off over the weekend from SWIFT, which is the worldwide payments transferring mechanism, will basically impact not only Russia, but also the countries where Russia is paying its debt repayments back to, because Russia is in some significant debt to parts of Europe. And without being a member of SWIFT, the ability to get repayment on those loans will be compromised. So sanctions are a two-way street, and the hope is that they impact Russia to a greater extent than what they impact the rest of the world. The key message this afternoon that I wanted to say is that we've had geopolitical incidents right back since the Second World War. So when Nazi Germany invaded Poland, right down the bottom of the chart there, you can see the impact on world markets leading up 3 weeks out, 3 months out, 1 month out, and a week out, what world markets were doing at the time in a pretty depressed sort of environment, to the weeks and months afterwards with markets recovering. So the other aspect that we've seen in this chart is that in the vast majority of cases, after 12 months post the event, we've seen world markets bounce back significantly harder than what they have been performing at prior to the geopolitical impact that has occurred. That's every single situation here is different. The lead up was different, the post was different, and the circumstances of the geopolitical incursion is obviously different. However, on the weight of the world needing to get on with life, of economies trying to recoup the lost production that they've had since, particularly in our circumstance, the COVID situation, we've already got economies that are looking for opportunities to rebound, to recover. So there's a greater possibility that after we get through the flashpoint of what's happening with Russia and Ukraine, we will start to continue to see the increasing employment around the world in what is a low interest rate environment, and possibly a recovery. Why is all of this so important? Certainly one of the discussions that I've had with a few people over the last week has been, well, shouldn't we just pull our money out and go to cash? We've basically had 10% negative if you just invested in US shares since the 1st of January. A balanced portfolio is probably down by between 0.5% and, not 0.5%, 5% to 7% for the calendar year so far. We've already had the reduction in the value of those investments. So taking the money out now would crystallize that reduction. The next question is, when do we actually get the money back in? Unfortunately, there isn't anyone ringing a bell to say this is the best time to rebuy because the market is at its lowest point and all you're going to get is up from here. What I can tell you, over the longer term, it pays to remain invested. The chart that I've got on the screen at the moment is what's called the Dalbar chart. Dalbar are an association in the US that have surveyed investor behavior. It's more of a psychological chart for people to emphasize the reasons why they should stay invested. This tells us that between 1992 and 2022, if you had remained invested in the market for all of the 7,738 days in that period, your market return would have been 9.21%. If you had decided to miss 100 of the best days by saying, I think I'll take a 6-month breather, I'll pull my money out, and that time just happened to be the 100 best days. So if you've missed those 100 best days, instead of the 9.21% that you would have gotten had you stayed invested, you would have got negative 2% just about by missing those days. If you'd missed just 10 of those days over that period of time, you would have dropped 2% in terms of return on what you would have been able to get. 25 best days, that's not a lot of days between 1992 and 2022. But if you'd missed those 25 best days, then your return would have been more like 5%. So staying invested, staying the course makes a big difference for your wealth over the longer term. And we're not in a bad situation around the world. With our economies emerging from COVID, there's been massive stimulus pumped in to get people back to work, to reopen businesses, and to generally get economies moving again. Not only in Australia, but around the world, we've got the lowest unemployment rates in a generation. So more people are in work than what we have had in many years. And at the same time, we've got more jobs being created. It's certainly a focus of governments to rebuild their economies through getting people back to work. Even after interest rates have gone up a little bit, we're still in very, very low interest rate environment, historically low, and they are likely to keep interest rates at historically low levels for a long period into the future. One of the things that governments are very worried about is the inflation that I talked about earlier, where oil prices are going up, where commodity prices are going up because of conflicts like what's happening with Ukraine and Russia. There are other impacts of this increase in economic activity on prices, and certainly we've already seen some of those impacts start to play out with inflation creeping up. To keep a check on inflation, interest rates will need to be increased slowly over time, but the government realises that we're still in a very tentative environment, and increasing interest rates too much will lead growth to stop. And certainly that's not anything that we want to have happen. So interest rates are likely to remain low for a long period of time, encouraging economies to continue their path to recovery. So we've got a pretty good scenario ahead of us as far as the economy goes. Certainly got plenty to worry about geopolitically. Certainly maybe seeing the beginning of a closer working relationship between Russia and China, and we need to manage those expectations as we go. But the point of this afternoon was to let you know that we have markets that aren't overvalued anymore because of the corrections that we've had so far over the last 6 months or so. We're in a good position to take the economy forward. We've got plenty of job vacancies out there and low unemployment, and we also have a period of low interest rates that is likely to continue on into the future. Naturally, everybody's circumstances are different, and I welcome the opportunity to talk through anyone's particular circumstances, so just reach out and let us know if you'd like a further chat. I'd just like to also acknowledge those people in New South Wales, Northern New South Wales, and Southeast Queensland that are about to commence the flood cleanup. We've still got rising rivers on dam releases and high tides, which will mean that the flooding is not over as yet. We're certainly hoping that we're going to get to the end of this soon so we can get out and get the Mud Army going again and look after everybody like we've always done in the past. Again, if you need to speak with me, please give me a call. Hope you found this valuable, and please forgive me for any glitches and stumbles with this new technology. I'm hoping that this might be a good way to come to you very quickly with messages in the future. So thanks very much. Give us a call if you need us, and stay safe and look after yourselves.